the biggest story. The Nigeria's statistics office released the country's rebased consumer price index today, showing a lower reading of 24.8% for last month, which the NBS says was compared to the base year of 2024. Here is an excerpt from the presentation by the Statistician General.
The all-item index, which is used to measure headline inflation for January 2025, was 110.7. 110.7. That's the index. And this index resulting in a headline inflation of 24.48% on a year-on-year basis. 24.48% on a year-on-year basis for January 2025. This increase was mainly driven by food and non-alcoholic beverages, restaurants and accommodation services, as well as transport. The food index for January 2025 was 110.03. That's the index. And this index resulted in a food inflation rate of 26.08% year on year. Another index of importance that I want to mention is the core index, which is all items, less farm produce, and energy. This index for January 2025 was 110.7, and this index gave rise to a core inflation rate of 22.59% year on year. If we disaggregate this result by sector, the urban inflation rate was 26.09%, while the rural inflation rate was 22.15%. In line with improvements made to the reporting of the CPI, going forward from now, NBS will be publishing some new special indices to inform policymakers. This is based on demand and requests from our stakeholders while we are engaging them during the exercise. These special indices include the Farm Produce Index. We never had this before. Farm Produce Index, Energy Index, Services Index. We all know the contribution of services sector to our economy. So we are going to be having inflation rate for that services sector. Goods Index, as well as Imported Food Index. Some of us also are aware of the pass-through effect of exchange rate and the resultant cost to imported food inflation. It's also a major contributor to headline inflation. So we are going to be having specific inflation rate for imported food. For January 2025, these new special indices produce the following inflation rate. Distinguished ladies and gentlemen, please note that these rates, they are not year on year. You know, it's a new rate that is just coming. We don't have them in the past, so we cannot have year on year. Like the headline that we just mentioned now, that we call the headline, and the urban rural that we have year on year. These new ones, they don't have year on year. Because they are new, the year on year rate for them will commence in January 2026, because we'll have had for 2025, then we can have year on year. While the month on month rate will commence in February 2025, because this is just the first one that we are releasing now. So we won't have year on year and then month on month. The rates being reported here are January compared to the base year, not year on year. So it's just compared to the average price of all the prices from January to December 2024. That is the base year, which is an average of prices in 2024, as I've just mentioned. So for these special indices, when we compare January to base year of 2024, for farm produce, we have the inflation rate of 10.50%, farm produce. For energy, we have 8.9% inflation rate for January. And for services index, we have 10.41%. For good index is 10.79%. And for imported food index, it produced inflation rate of 11.47%.
Great, that's Nigeria's Statistician General and the head of the National Bureau of Statistics. Let's bring on my first guest tonight on the rebate CPI and what it means for the financial markets. Johnson Chukwu, a market professional and the group CEO at Carry Asset Management. Great having you connected into the RS Exchange tonight.
Good evening, boss, and thank you for having me.
Thank you for making the show tonight. Give me your first take on the rebate CPI.
We're looking at a figure that of 24.48%. It largely agrees with some of our expectations. At the beginning of the year, we made a projection that this year's average inflation rate should be in the region of 25%. And the reason is that you have a huge base effect. Recall that the rebased GDP is using the average of 2024 prices as a base price. So basically, you're saying that the average prices in 2024 have increased by about 24.48% in January this year. And that is in tandem with the expectations of most analysts who had actually predicted that price increases this year will be in the region of 25%. So the figure did not come as a surprise to me, because when I recognized the fact that they used 2024 average price levels as the base year or the base prices to determine the new inflationary figures or inflation figures, then it just adds up that the increase in average prices in the first month of this year should not be materially higher than 24.48% that they announced.
But how has the market received the news of the lower inflation for January when you talk about retail investors? What have you heard, if we stick first with the business and market executives so far on the latest rebased inflation number?
You know, what has happened is that when people heard the figure of 24.48%, the first thing that hit them is, how did we just drop from 34.48%, 34.8% in December to 24.48%. But they need to sit back and look at what is now the base year. Like I said, there's what you call the base effect. And the rebasing the inflation figures, or the base of computing inflation using the average prices last year, simply meant that the increase in proportion will no longer be as severe as it was. So the first feeling people had that it hit them as a surprise. But for an analyst like you and I, we understand that the base year 2024 was a period when we have elevated prices. So further increase above the average prices last year is not going to be as steep as it was when we were comparing the base year about 2009. So for the market, the first thing they had was doubt. But I believe with this kind of engagement we're having now, we further explain to the citizens that it does not mean that there's no magic that the Nigerian Bureau of Statistics did, other than they used the base year that they had elevated price levels. And that is now the base that we're going to be using to measure change in average price level.
Yeah, sorry, Johnson Chukwu, about that loss of audio. How should a rebase CPI be understood by investors? Yes, we understand the man on the street, but investors for last year, the year before, were thinking about how much highly elevated inflation impact their return on investment, whether they're investing in stocks, whether they're doing bonds, or whether they're in currency, whatever they're doing, or mutual funds. Everyone was worried about the impact of inflation on whatever assets, their financial assets they're holding. Would this recent, the latest CPI rebasing, will it change anything, as it were, as far as investors are concerned?
Yeah, yes, both in it will. Remember that investors are actually gauging whether they're having effective, positive net return on their investment or negative net return on their investment. When the return on investment is lower than the inflation rate, the investor are actually getting a negative return on their investment, in the sense that the value they would have obtained if they had made purchases or consumption without making investment would be eroded if they would have lost value if they make an investment that gives them returns lower than the inflation rate. And the simple principle is this: if I have 100 naira and I can buy a product today for 100 naira, and I decide to invest that money, that 100 naira, and I'm expecting a return of 20%, so at the end of the year I expect 120 naira. Then if I go to the market and have to buy the same product I would have bought for 100 naira and 130 naira, then I have to look for under 10 naira to buy it. So in that case, my investment is actually negative, because I have to really incur the deficit in terms of the price levels, what I could have afforded prior to that investment. So when you have an economic environment where the return on investment is negative, the real return is negative, investors are compelled to consume. They shy away from making investment in that local currency. And you see a migration to foreign currency assets that will give them some level of protection against depreciation in the currency value, as well as movement in local price levels. But if you have an inflation rate that is below the return on average assets, particularly be it equity instruments or variable income assets or fixed income assets, investors have more confidence in investing in that local economy or investing in the local currency assets of that economy, because effectively they're going to get returns that are higher than the loss in the local currency value as a result of inflation. And what we're seeing that if we have an average inflation rate of about 25%, at a time when, until recently, or the last week, when Treasury bills yield dropped, we were getting Treasury bill yields in the region of 26-27%. And beyond that, equity market returned about 37.65% last year. So the investment instruments in the country today are giving returns above the current inflation figure of 24.45%. That, for me, will encourage both individual and institutional investors to invest more in Nigeria's local currency assets, be it fixed income instruments or local variable income assets like equities.
So what are you hearing from investors, local investors right now, as far as inflation is concerned?
I think a lot of local investors are, first of all, needed to understand what it means to say that the inflation rate in January is 24.48%, which I think in the next 1 or 2 days, they will get to understand, that will sink in, and they will know that these figures are not made up, and that these figures are real based on the base that had been used. But most important, when you are making an investment, you're not making an investment of the previous year, you're making an investment going forward. Investment is always futuristic. So you're making an investment today and asking yourself, what kind of return will I make on this fixed income asset? What kind of return will I make on this variable income asset? Be it equity, be it mutual funds, or whatever it is. So if you gauge that the return you will make is above the expected inflation figures for the period, then it makes sense for you to make an investment. So I expect that in the next few days, you're going to see investors intensify their investment in Naira assets. Particularly, there is going to be an auction tomorrow of federal government treasury bills, and I expect that you're going to see a very aggressive bid for those treasury bills, because investors are going to be looking for any instrument that will give them yield above 24.45%. And currently, federal government treasury instruments are giving yields higher than the inflation figures. Yes. So I think investors are going to come back to the market and aggressively bid for Naira instruments.
Yeah, we've seen aggressive bid for treasury bills at the central bank auction almost on a weekly basis. The last 3 weeks or thereabouts seem to be a little bit flattish as far as the short-dated papers were concerned. Bids were in the trillions of naira. So 700 billion going on the table tomorrow by the central bank. How do you think the market will price this in terms of the rebase inflation reading when they're looking at, yes, if I was getting XY figure earlier, what would be the outlook for me and for you, for those of you who are doing inflation and the market analysis for investors? Will the latest inflation or CPI rebasing get your analysts back on the table and begin to take a second look at inflation expectations towards the rest of 2025?
Yes, most analysts that understand the basis of computation of inflation had actually expected a moderation in inflation in 2025. So, like I said earlier, this is in tandem with most of the expectations. But what will happen is that investors are going to now gauge which instrument should they invest in. Like we're talking about treasury bills. If you look at the treasury bills auctions and look at the bid ranges and the yield expectation of investors, you'll see that it's very wide. You see people asking for as high as 30% yield on treasury bills. So you're going to see that moderate significantly. You're going to see people bidding in the region of 20 to 25% yield on treasury bills. And I don't even think anybody will go for as high as 25% because you likely know that you're not likely going to win that bid. So people are going to be moderate their expectation in terms of return on risk-free instrument like treasury bills. And that will obviously dovetail or trickle down into other fixed income instruments that have strong credit quality. But most importantly, investors' expectation about inflation rate for this year will begin to moderate. People expect that inflation in the region of, like I said, at the end of the year, you shouldn't expect an inflation materially above 25% because some of those factors that drove inflation last year are not going to be there. But most importantly, you are now talking of inflation based on a new base, and that base was already elevated. The price levels in 2024 were quite high. So we're talking of increases above the price levels of last year.
Just before we talk about the monetary policy meeting starting tomorrow with decision on Thursday, quickly, where are we on the Eurobond market? Just before the inflation or rebasing or the CPI announcement, the Nigeria's Eurobond said to yields went down. What did you see today on the trading engine?
Well, I think it was largely around the same rate it was last year. Yesterday we didn't see any major movement. Probably with the inflation figures that came out today, we should see people now pricing that in terms of their investment in Naira, Nigeria's dollar instrument, the Eurobond instrument. But most importantly, what people look at is this: what is Nigeria's foreign exchange earning capabilities? The figure that were published by the NUPRC say that our crude oil production had increased about 1.7 million barrels a day, and that we're doing about 1.535 million barrels of crude plus about 1.9 million barrels of condensate on a daily basis. That will give investors the confidence that Nigeria's external condition, external balance is actually strengthening. So if that is the case, beyond the reserve, the over 40 billion reserve the central bank has been putting, what people are looking at, what is the earning capacity of this economy to earn foreign exchange? And if that continues to improve, investors will be ready to take lower yield, to ask for lower yield in investing in Nigerian government Euro bonds. Mm-hmm. So you're going to see increase in prices as well as reduction in yield.
All right, so we're down to the considerations by the central bank's monetary policy on Thursday, the first in the new year. How do you think the committee should decide on the announced inflation rebasing? What's your take?
Yeah, Boston, the inflation is one of the factors they consider, they take into cognizance in arriving at the decision. There are several other factors. You have to look at the GDP performance. We don't have the rebate GDP figures. The last figure we have of GDP is the third quarter 2024 GDP of about 3.46% growth. But then there are other variables that have come up in the new year. We're dealing with a very unstable global macroeconomic environment. We're dealing with expectation that oil prices could moderate, although it had moved up yesterday and today. Brent has gone back above $75 per barrel. But there is every indication that the U.S. will do everything to bring down crude prices. There is already a discussion ongoing to resolve the Ukraine-Russian war. These are variables that will change the macroeconomic environment. The U.S. government said they're going to reduce corporate tax and individual taxes. That could lead to an increase in interest rates in the U.S. if the U.S. government deficit increases and the government has to borrow more. So I think what the Monetary Policy Committee will do is weigh all these uncertainties. Now we have the GDP figure we have the CPI figure, that is the inflation figure. But the inflation figure did not deviate from or diverge from what most people expected. So if they have to consider the fact that we have inflation figure of 24.48%, which is still high by every standard, we have a gradual return on pressure on the FX as a result of the reopening of the Chinese market. So what they should do is to wait for the GDP figures, which will show us the direction the economy is going, wait further for some of the Trump policies and how it impacts our major export commodity, which is crude, how it impacts on global prices, and then before they take further decisions. I think the most appropriate decision to take at this point, given the number of uncertainties, is to hold. Remember that we are still dealing with counterbalancing factors. One, you are dealing with a relatively high inflation rate because 24.48%, that inflation rate is still high. We are still dealing with a very relatively fragile economic growth because if you take out growth in the financial services sector, you take out growth in the telecommunications sector, you find out that the growth, and you take out growth in the oil and gas sector, you find out the growth in third quarter of last year was very flattish. Because the major contributor to the economy, agriculture grew about 1.14%, manufacturing at about 0.9%, trade about 0.6%. So these are the major hitters in the economy, and the growth is very weak. So you really cannot continue to tighten at the point when your economic growth rate is fragile. So my thought is that they should hold and watch the global economic environment further before taking any definitive direction of whether to tighten further or to loosen.
All right, put it down. That's a hold for you on Thursday. Thank you so much. Your professional insights are well appreciated as always on the show. Johnson Chukwu, the Group CEO at Carrier Asset Management. Do have a wonderful evening.